You are now in your 40s, which means that you are busier than ever. You are now married, own a house, and have children of your own. You are probably thriving in your career and earning more money than you have before. With so much happening in your life, it is completely common to set aside your finances. But it is also important to plan now for your future needs and those of the people you care about. We have been getting a lot of requests from people in their 40s about investing for their retirement. And in today's video, we will be discussing the important factors when it comes to investing in your 40s. Here is one common misunderstanding about investing in your 40s. Believing that it's too late to start investing. Many people believe that if they haven't invested earlier, it's too late to start in their 40s. However, this is not true, as there is still time to invest and grow one's wealth. Many people in their 40s do not have well-defined retirement strategy. Other people save, but it is not going to be enough. This stage of life often comes with big expenses, like paying for your kids' college. This makes it hard to build up a big nest egg. Your parents, on the other hand, are getting older, and their health is deteriorating. They may need your help and care, or they may want you to pay for some of their caregiving needs. This can have a big effect on your finances. In fact, 42% of American adults with living parents worry that their parents will become financially dependent on them. Covering all the bases can be daunting, but we have put together some necessary steps and suggestions that will help you reduce your worries. Keep in mind that people move through life stages at different rates. Step 1. Take care of your financial needs. When planning for your retirement, think about your ideal retirement lifestyle and then be realistic about what it might cost. Once you have a financial goal in mind, you can work with a financial advisor to help develop a strategy to get there. Using a budget to identify where your money comes from and control where it is going will help ensure you are living a lifestyle you can afford and are on track to meet your savings goals. Knowing how much you spend now can also help you figure out how much you will need to spend when you retire. Credit card balances can hit new highs in your 40s. This is a big impediment to saving for retirement. If you are serious about saving money, look into low-interest credit cards. On the other hand, if you have saved at least 10% of your paycheck for the past 15 to 20 years, then you may only need to tweak your habits to hit your savings goals. However, if you have otherwise neglected retirement, you are going to have to push hard to make it to the finish line. Step 2. Max out your retirement contributions. Retirement may still seem like a lifetime away, but it's closer than you think. While you have a good 20 to 25 years of work left, the cost of living during that time can double. During periods of high inflation, such as those the United States of America faced in the 1970s and again in 2022, it can increase even more sharply. Now that your income is likely to be higher, make sure you are taking full advantage of it. While everyone's needs are different, a good general rule of thumb is to save 10 to 15% of your income for retirement. You may even want to max out your annual contributions. The IRS is allowing up to $22,500 in contributions to 401k plans in 2023, while the limit of individual retirement accounts and Roth IRAs is $6,500. If you don't have access to an employer-sponsored retirement plan, and even if you do, consider either a traditional IRA or a Roth IRA. Step 3. Develop a smart investment strategy. Investing is a pivotal piece of your financial strategy. When developing your investment strategy, you'll want to consider your goals. when you will need to access your money and your comfort level with the risks. For short-term goals such as saving for your dream vacation, you will generally want to hold cash and short-term fixed income investments. For long-term goals such as retirement, you have the leeway to invest more in high-growth securities, which often carry a high risk of loss but can also offer higher returns. Diversification and asset allocation are still crucial today, according to Ellen Rinaldi, a former corporate director for Vanguard. You are still a long way from retirement at the age of 40, so don't rush to play it safe. With a typical retirement of more than 2 decades, it still makes sense to have your portfolio heavily weighted towards stocks. Stocks are one of the most volatile asset classes, but they also provide some of the best total returns. Step 4. Prepare for the unexpected. Make sure your strategy includes contingency plans that prepare you for the unexpected. For example, what would happen to your family if you were suddenly unable to provide for them? How would they replace your income or handle the things you do for them every day? Life and disability insurance can provide some protection. Step 5. Make tough decisions when it comes to education expenses. Did you know that it costs an average of $235,610 to raise a child until the age of 17? But what often comes at age 18? College, and the many expenses associated with it. Ideally, people in their 40s who have children of their own have been saving for their kids' high education since they were in diapers. If you plan to pay for some or all of your kids' college education, you will need to be prepared for the costs. Your options include pursuing scholarships, taking out loans, and using your personal savings. The third choice may save you some money in the long run, because the more you save now, the less you will need to borrow later. Those who have neglected to save for college and whose retirement savings are not where they should be may not have enough money to fund both. As a parent, you may want to take care of your kids, but financial advisors agree that saving for retirement should be your top priority. Putting the finishing touches on your plans for your children's education as they become adults is a great way to teach them good money habits. Step 6. Invest in insurance. The cost of healthcare appears to rise year after year, and we are living longer and longer lives. Those are 2 reasons why long-term care insurance is a popular choice for many consumers. The Department of Health and Human Services estimates that 70% of American retirees will require some sort of long-term care, depending on the kind of service required. The median cost of these services in 2021 ranged from about $59,000 to $108,000. You can take a chance that you won't require long-term care insurance, but if you do, it could severely impact your retirement. The American Association on Long-Term Care Insurance states that for those who are 55 and older, long-term coverage of $165,000 can cost several $1,000s a year and go up from there, depending on whether you want that benefit to increase over time. Step 7. Work with a financial advisor. If all of this planning seems like an overload, a great option could be turning to a financial advisor. Experienced financial advisors have seen it all before and will work to meet your financial goals. They'll be able to set up financial plans that balance your needs and income, and they will help you establish your priorities. In short, they will be able to help you get your financial house in order, while you still have enough time to achieve your goals. If you are looking for someone to manage your investment plan, then a robo-advisor is a great option. A robo-advisor can set up an investment plan based on your time horizon and risk tolerance. Step 8. Keep all your assets in view. Maintain a broad view of all of your holdings as you reallocate assets. It's not enough to focus on just a 401k. Take all of your investments into account. Make sure that you haven't forgotten anything, like a 401k or other benefits you may have earned at your previous jobs. If it's an old 401k, roll that into an IRA in which you can invest in anything you want, or move it to your current employer's 401k plan if there are good investment options needed. It happens all the time. People forget about their 401k plans and spend more time on vacation than they do on retirement planning, says Michael Scarborough, owner and CEO of Oak Wealth Partners in Washington, D.C. Keeping one's assets in view is important for several reasons, including, first, financial management. Regularly monitoring assets helps individuals keep track of their financial situation, identify areas where they can reduce spending, and make informed decisions about future investments. Second, security. Keeping your things out in the open can help keep them from being lost or stolen. It can also make it easier to spot any strange behavior or unauthorized access to your accounts. Step 9. Consider working longer. While continuing to work after retirement is the exact opposite of it, taking this path may be necessary to make retirement comfortable. Even so, there are some advantages to working longer, and it might improve your retirement significantly. First, working longer allows you to continue to bring in more income. This extra money can be saved and invested, helping to secure your finances. Unlike the full-time job you most likely held for the majority of your working life, some people continue working, but do so at a reduced level. You may match your working hours more closely to your expenses. Meanwhile, your assets continue to accumulate and give you a longer retirement runway. We had such an amazing time educating all of you about investing in your 40s. Do leave a comment down below with all of your insights and lessons you learned while watching. We would like to thank you for watching this video, and please do not forget to like and subscribe to our channel.